We've had a pullback, but the fundamentals, given the fact that we're now at war, are even better for gold and silver than when we were at peace. So you got better fundamentals and lower prices. So what are you waiting for? Buy your gold and silver this weekend. We did have a big rally in gold and silver, so there was some profit taking. If Iran just surrendered, right, and oil prices came down tomorrow, I think gold and silver prices would go up there too. I think you could just see gold up $200 or $300, silver up $10, in one. Just going to happen. Gold has failed to rally, which has disappointed some people who own gold. I'd be like, oh, this is my chance. I'm buying this dip. And don't worry, if the dip it gets bigger, who cares? You've got a great opportunity to establish a position. We're going to have bigger increases in the CPI. That is also pushing up bond yields. The price of gold had in part been supported based on the idea that the Fed was going to be cutting rates. Pretty much everything seems to be trading opposite of oil. If oil is going up, gold's going down, stocks going down, bonds are going down. The gold and silver traders are missing the forest for the trees. They are looking at a very short-term impact on higher rates, higher inflation, leading to a tighter Fed, and missing the bigger picture that a weak economy and bigger budget deficits are going to actually have an easier Fed and a weaker dollar and an environment that is extremely bullish for gold and silver. In fact, look at all the other commodities that are going up now, right? They're catching up. Look at oil, look at agriculture, and everything is finally moving. Gold was moving first. Now it's taking a break. Money is starting to move into some of these other commodities. If you recall, I was telling my audience how I was putting a lot of money into energy stocks because I had so much in gold stocks. And I got in on those before any rally because I knew it was coming. I knew this was going to be a major commodity bull market. And I knew that the laggards were going to catch up while the leaders take a breather. The leaders were the precious metals, gold and silver. They're taking a breather, and some of the other commodities are now on the move, but they're all going to be going up in unison. And in fact, one other thing that's happened, as gold has failed to rally, which has disappointed some people who own gold, Bitcoin has caught a bid. Bitcoin, finally got back above 70,000.
Commodity markets rarely move together at first. Leadership rotates quietly before the broader surge begins. As Peter Schiff points out here, investors focusing only on short-term rate fears may be missing the structural forces building underneath the economy. When deficits expand while growth slows, central banks historically pivot faster than markets expect. We saw similar rotations in the early 2000s when energy and agriculture followed metals into a broader commodity cycle. Meanwhile, Bitcoin reclaiming $70,000 may simply reflect temporary capital rotation rather than conviction. Next, Peter Schiff discusses why the sudden strength in Bitcoin may actually signal weakness beneath the surface.
In fact, earlier today, I think it got almost to 74,000, 73,900. Couldn't hold that rally as we're speaking. I'm speaking. We're down around 7,100, but we're still, 71,000, excuse me. So we got to 73,900 and change on the high. So we're above 71,000 because I think some people, when they sold some gold or moved out of gold, they thought, okay, maybe we'll buy Bitcoin. I think the main reason that Bitcoin is not tanking is because Michael Saylor keeps buying it, right? He's the big buyer, propping up the market. But again, this is a dead cat bounce in Bitcoin. I think, there's a little bit of a spark in it now because, gold and silver are not going up. But I think the catalyst for the next leg down in Bitcoin, and it should be a big leg, will be the move up in gold and silver. And I expect that almost any day. I think you could just see gold up $200 or $300, silver up $10 in one. Just going to happen. It's just going to happen. The selling is going to be exhausted, and something's going to happen. There'll be some catalyst, and off to the races. Maybe the dollar will break. Maybe the bond market will break. Something is going to happen, and the market's going to fly.
Bitcoin rallies often look powerful on the surface, but the liquidity behind them can be surprisingly thin. As Peter Schiff points out here, a move to nearly 73 tfatat, $900 that quickly fades back towards $71,000 suggests momentum traders rather than long-term conviction may be driving the price. Markets sometimes hinge on a few dominant buyers, and when positioning becomes concentrated, the risk profile changes dramatically. If capital rotates back into commodities during inflation scares or currency weakness, speculative assets historically lose leadership fast. Next, Peter Schiff shows why a sudden surge in gold and silver could trigger the next major shift in market sentiment.
Now, I think a lot of people think what we need is a quick resolution to the war, and that'll make gold and silver go up. And it probably will. The way the market is trading right now, if Iran just surrendered, right, and oil prices came down tomorrow, I think gold and silver prices would go up there too. But I think that the war dragging on is even more bullish for gold and silver. Not that I'm rooting for the war to drag on. I'd like it to be over. I don't want more people to die. I'd rather have the war come to an end. But I think that that's probably not going to happen. But I also think that while the war ending right now would be bullish for gold and silver, it continuing to wage on indefinitely is even more bullish. You know, Trump keeps saying, oh, this is not a forever war. Well, we'll see. We'll see. And, of course, nothing lasts forever, but they last for a lot longer. And if we end up having troops on the ground, which I think is the only way we could win, right? If Trump holds on to the idea that it's regime change and we're getting rid of the current regime and we're replacing it with somebody else.
Markets often react less to the start of conflicts and more to how long they drag on. As Peter Schiff points out here, investors tend to assume a quick geopolitical resolution, yet history shows wars frequently extend far beyond initial expectations. Longer conflicts raise government spending, pressure currencies, and reshape global commodity flows. That combination historically supports hard assets, while weakening confidence in fiat stability. Investors should remember how prolonged conflicts in the past decade quietly pushed energy and metals higher even when headlines faded. Next, Peter Schiff talks about the deeper military and economic realities that could keep this conflict unfolding longer than markets expect.
I don't see how we're going to succeed in doing that with missiles and bombs. And by the way, what happens when we run out? Yeah, I know we can order more and that the companies can build more, but how long does that take? I don't know how many of these bombs we got, how many of these missiles we got, right? Because we're obviously shooting a lot of them right now. And as Trump said, pretty soon there's not much left to destroy. Once we get all their real buildings, I don't know, they're hiding underground. I don't know what the deal is, but how long are we going to keep on bombing? But this thing can go on. And the markets are going to figure this out. So right now you've got the head fake. You've got traders that don't understand. We did have a big rally in gold and silver, so there was some profit taking. Gold and silver mining stocks were way up on the year, and so they were ripe for a pullback, and the war provided that catalyst. But it's a shakeout. The weak longs are being shaken out. It's just an opportunity as far as I'm concerned.
Short-term pullbacks often disguise the bigger structural trend building underneath markets. As Peter Schiff points out here, traders frequently mistake profit-taking after strong rallies for a full reversal. Mining stocks had surged earlier in the year, so even a modest geopolitical shock could trigger selling pressure. But historically, commodity bull markets are filled with these shakeouts that remove leveraged traders before the next leg higher begins. Investors watching only daily price swings often miss the broader supply constraints forming beneath metals and energy markets. Next, Peter Schiff discusses why these sudden pullbacks may actually create the best entry points in the cycle.
I haven't sold any of my mining stocks. I haven't bought more yet, personally, because I have so much. But, you know, if they fall, if we get a bigger decline, I'll have to do it. You know, even though I'm so loaded up, I'll buy more. I mean, if the market's going to give me that kind of a gift, you know, who am I to turn it down? But right now, you know, prices are still up, you know, on the year. And while I think they're cheap, right, for me, they're not cheap enough to buy more, given that I'm overwhelming gold and silver. But if I was underweight gold and silver mining stocks, I would be adding to my position right here. And if I didn't have any, I would be a big buyer, right? If I was just on the sidelines and I wasn't in the market, I'd be like, oh, this is my chance. I'm buying this dip. And don't worry, if the dip it gets bigger, who cares, right? You've got a great opportunity to establish a position. If you've been sitting on the sidelines missing this whole rally, what are you waiting for?
Many investors wait for the perfect entry point and end up missing entire market cycles. As Peter Schiff points out here, disciplined investors often view corrections as opportunities rather than warnings. Mining stocks remain volatile because they amplify movements in the underlying metals, which means dips can feel uncomfortable even during strong long-term trends. Historically, commodity bull markets reward gradual accumulation more than perfect timing. For portfolio strategy, the real question isn't whether prices fall temporarily, but whether the macro environment continues supporting metals. Next, Peter Schiff talks about how positioning and allocation decisions shape long-term outcomes in commodity investing.
You got another opportunity. Yes, it's not as good as had you bought a year ago or 2 years ago, but it's better than someone who bought a month ago or 2 months ago. And if you wait a couple more months, who knows how much higher prices could go. So again, I like my gold fund, the Euro Pacific Gold Fund, EPGIX. You can buy that no load at any discount broker. Go to my website at europac.com, EUROPAC.com, to get the information on my gold fund. In fact, you can get information, prospectuses on all 5 of my funds. They're all going down right now. Stocks are going down. The dollar's going up. Emerging markets are going down. I think there's lots of opportunities because the positive momentum is going to continue despite being disrupted by this war. And to me, this is a negative for the dollar. It's a negative for the U.S. It's a negative for dollar hegemony. It's a negative for our position around the world.
Markets rarely offer perfect entry points, but they often leave small windows that disciplined investors recognize quickly. As Peter Schiff points out here, when multiple asset classes fall at once, stocks, emerging markets, and commodities, it often signals a liquidity shift rather than a collapse in fundamentals. Historically, these moments occur during periods of policy uncertainty or geopolitical shocks, when capital temporarily crowds into the dollar. Yet the bigger question for investors is whether structural deficits and global debt expansion eventually reverse that dollar strength. Next, Peter Schiff talks about why the dollar's recent rally may not be nearly as strong as it appears.
And even though the dollar has rallied, this is not a huge rally. This is not the type of rally that we would have had in 1990s, 2000s, when we're going into wars. This is a very muted rally in the dollar. And it had already been falling. So, there was some short covering there. So it's not an impressive rally. I think the dollar's reign as the primary reserve currency, as the safe haven is over. I think the crown has been passed to gold. And I think you're going to see that continuing in this year as we get deeper into this war and as the traders start to react to the bigger picture, rather than what's happening right in front. And in the meantime, again, we got another weekend. I still think that you want to be long gold going into Sunday, regardless, even if oil goes way up, there could be this big move.
Safe haven rallies in the dollar used to be explosive, but lately they've looked strangely restrained. As Peter Schiff points out here, the recent bounce lacks the strength historically seen during past conflicts in the 1990s and early 2000s, when global capital flooded into US assets. A muted move like this often signals heavy short covering rather than genuine long-term demand. For investors, that distinction matters because weak safe haven flows can hint at declining confidence in the underlying currency system. If that trend continues, capital could quietly migrate toward hard assets again. Next, Peter Schiff discusses why gold may increasingly replace the dollar as the world's primary safety trade.
And the big move is more likely to start in Asia, I think, than it is in the U.S. And why not on a Sunday when Americans are still, enjoying the weekend? and not paying attention while it's Monday in Asia, and they could be buying. So don't wait for Monday. Go to the Schiff Gold website and fill up your cart with gold and silver. The phones have, calmed down, so you can talk to a representative now a lot more, a lot easier than a few weeks ago when things were kind of hectic. But that kind of tells you it's a better opportunity now that it's not as frantic. People were rushing to get in, and now we've had a pullback. But the fundamentals, given the fact that we're now at war, are even better for gold and silver than when we were at peace. So you got better fundamentals and lower prices. So what are you waiting for? Buy your gold and silver this weekend.
Sometimes the quietest trading sessions hide the biggest shifts in global capital flows. As Peter Schiff points out here, commodity moves increasingly begin during Asian trading hours, reflecting how demand for metals is gradually shifting away from Western financial centers. When Western investors step back during weekends or holidays, Asian markets can drive price discovery with physical demand rather than paper speculation. That dynamic has been growing for years as central banks and investors across Asia accumulate reserves and commodities. For investors, watching liquidity cycles, where price moves begin, often reveals who truly controls the market. Next, Peter Schiff shows why this global shift in demand could accelerate gold's next breakout.
Now, that is what I believe has been weighing on the price of gold. The strong dollar, rising interest rates, long-term rates, and rising oil prices. Now, why are these things considered bearish for gold and bearish for the mining stocks? Well, the markets are now concerned that rate cuts that they were expecting are not coming, or they're going to be delayed, because rising oil prices obviously are going to reflect in the consumer price index. We're going to have higher increases, bigger increases in the CPI. That is also pushing up bond yields. And the price of gold had in part been supported based on the idea that the Fed was going to be cutting rates. And now that investors are backing out those rate cuts or pushing them further into the future, that is weighing on the price of gold. In fact, gold is almost trading opposite oil. In fact, pretty much everything seems to be trading opposite of oil. If oil is going up, gold's going down, stocks going down, bonds are going down, and if oil's going down, you get a reversal. So oil is kind of driving everything. And people are baking these higher oil prices into the scenario. In fact, more people are now talking about stagflation. I've been talking about it for years, but now more people are talking about it given what's happening both with inflation and the economy. But I think the markets have got this wrong.
When markets suddenly link every asset to one variable, it often signals oversimplified thinking. As Peter Schiff points out here, investors are currently treating oil prices as the single driver behind inflation, interest rates, and gold's short-term movements. That kind of narrative dominance happens frequently before major reversals, especially when markets begin pricing out expected Federal Reserve rate cuts. Rising CPI expectations can temporarily strengthen the dollar and pressure metals, but historically, stagflationary environments eventually benefit hard assets. For investors tracking macro cycles, the real question isn't oil's direction, but how policymakers respond. Next, Peter Schiff discusses why the market may be misreading the long-term implications of rising energy prices.
What is happening now with the war and with oil prices and with bond prices, this is bullish for gold. It is not bearish. And in fact, it is bearish for the dollar. It's not bullish. People are looking just at the immediate consequences of this war and the impact on oil prices. What they're not looking at is the longer term consequences. The war is very expensive. We have to pay for that war. Where are we going to get the money? We're not going to raise taxes. We're going to have to increase deficit spending, which is already at a record pace. And ultimately, the Fed is going to be cornered into monetizing this debt. They can make a bunch of noise, but at the end of the day, when they're faced with an economic downturn and soaring deficits and rising long-term interest rates, the Fed is going to crank up the presses. That is bullish for gold and silver, and it's bearish for the dollar. And the war is going to harm the economy because the war is going to result in higher oil prices, which is going to be harmful to the economy, higher food prices. Look what's going on with fertilizer prices right now.
Wars rarely impact markets only through oil prices. The deeper shock usually comes from how governments finance them. As Peter Schiff points out here, prolonged conflicts historically expand fiscal deficits, forcing policymakers to rely on debt issuance and eventually central bank support. When deficits rise during economic slowdowns, the pressure often shifts toward monetary easing despite inflation concerns. Investors saw similar patterns during past geopolitical crises, where liquidity expanded even as growth weakened. For portfolios, the real risk isn't just higher energy prices, but the policy response that follows. Next, Peter Schiff unravels how deficit spending and monetary expansion could reshape the dollar's long-term trajectory.
And, you know, the U.S. may be a net exporter of oil, and I think this was rich. But Donald Trump all of a sudden came out on Truth Social and said, hey, high oil prices are good for America. This is great news because we're a net exporter, so we're going to make money. Now, you know, you can't have it both ways. Donald Trump was promising to lower oil prices. He said that we needed lower oil prices. Now that oil prices are soaring, he said, no, we need high oil prices because we're a net exporter, so we make money off of high oil prices. Yeah, I don't think Donald Trump would have got elected if that was his campaign slogan. Make oil companies great again. We need higher oil prices so oil companies can earn larger profits. Yes, you know, we may make money off of high oil prices, but not every American owns an oil company. Average Americans are net losers when they have to pay a lot more for energy.
Energy politics often reveals a quiet contradiction between campaign promises and economic reality. As Peter Schiff points out here, calling high oil prices good for America overlooks the simple fact that most households are consumers of energy, not producers. When gasoline, electricity, and transportation costs rise, those increases ripple across the entire economy through higher prices on food, goods, and services. Even if domestic producers benefit, the average consumer absorbs the inflationary pressure through everyday expenses. For investors, this creates a tension between energy sector profits and broader economic strain. Next, Peter Schiff discusses how rising energy and food costs could quietly weaken the overall U.S. economy.
Not just gas, but everything else that needs energy. But clearly this is going to weigh on the economy. But America is not a net exporter of food. We used to be, but now we're not. We actually import more food than we export. So we're net importers. So if food prices really start to go up, yeah, some farmers will make more money. But net, that's going to be a drain on the U.S. economy because we still have to import that more expensive food. But the economy is weakening anyway. This is what is lost in the sauce here. And maybe this is one of the reasons that Donald Trump decided to wag the dog with the Iran war, to distract attention from the underlying weakness in the U.S. economy. You know, Donald Trump is continuing to tell the lie that we have the strongest economy in the history of America, and that when Biden was president, we had the weakest economy in the history of America. And so he has pulled off a miracle that what has happened in the economy in a short period of time, it's an unprecedented reversal from the worst economy to the best economy. And it's all because of Donald Trump and his magnificent policies. Whatever those policies are, he is responsible for this record-breaking turnaround. Now, I'm not making this up. These are Donald Trump's words. This is what he says. He said it at the State of the Union.
Headline economic strength often hides deeper structural vulnerabilities underneath the surface. As Peter Schiff points out here, rising energy and food costs hit the economy differently when a country shifts from being a major exporter to a net importer, when input costs surge across agriculture, transportation, and manufacturing. Inflation pressures spread far beyond the grocery store or gas pump. Investors should remember that economic narratives frequently change during election cycles, especially when political messaging emphasizes growth while underlying indicators soften. The disconnect can create sudden market repricing when reality catches up.